Hey, welcome back. Today, we're tackling a question that some homeowners have, like this one.
My house has gone way up in value since I bought it in 2010. When I sell, will I owe taxes on the profits?
That's the issue we're addressing. But before getting into this, I just want to let you know I'm, a realtor. I know a thing or two, but I'm not a tax advisor or an attorney.
What are you doing, detective? What are you doing talking to my client without me present? You sneaky Pete.
So you'd want to get one of those guys to tell you what taxes you may owe. This is an overview of how profits on the sale of a home work, generally, because if you bought your home before the real estate market saw that big upturn, then you're likely sitting on substantial equity and a hefty profit. So will you owe any taxes at all on that profit? And by the way, our contact information is below. And if you find this information helpful, consider subscribing. So the profit you make from selling your property, capital gains, can be subject to taxes, but there are some generous exceptions. First of all, here's how to calculate capital gains.
First, figure the cost basis, the amount you paid for the house along with any fees associated with the purchase. To that, add the money you put into the house, any improvements like room additions, new roof, etc. Then add the selling expenses, brokers and attorney fees, advertising. That gives you the amount of money you've got in the property, the cost basis. Subtract that number from the selling price. The amount you received from the sale minus what you have in the house will give you your capital gains or profit.
And for many sellers, it's going to be a good bit given how prices have skyrocketed. The average of a home nationally in 2008, the bottom of the market, was $197,000. Today, it's $497,000. So if you bought a house that fit those averages, you made at least $300,000 profit if the full amount was subject to taxes. And that's going to be a pretty high sum. But here's the good news. The exclusion for a married couple is $500,000. So if the capital gain is less than that, it does not have to be reported to the IRS and you will not pay taxes on it. The exclusion for a single person is $250,000. And I do know a few people, single buyers, that made a profit over $250,000. So they would subtract the $250,000 exclusion from the profit they made. A client of mine bought her house in 2010 and the value of that home has tripled since then. So her profit exceeded the $250,000 exclusion. So in her case, she would subtract the $250,000 from the $275,000 profit she made, and that would leave $25,000 that is subject to taxes. There is criteria you have to meet to be eligible for this exclusion.
Number 1, you must have lived in the home at least 2 of the 5 years prior to the sale. Number 2, the home is your primary residence. And number 3, if you have used the capital gains exclusion before, it must have been more than 2 years ago.
So if you meet that criteria, you've got a pretty nice deal with these exclusions. If you reported part of your home as a business, then a depreciation for that, a portion of your home, would be part of the calculation when you figure your capital gains. And depreciation plays a key role in figuring taxes on a rental. Depreciation is a deduction that accounts for wear and tear over the years. There's also recaptured depreciation, and I'm not going to get in the weeds with all that. I'm not a CPA, so it's really more of something for your tax advisor to deal with. There's no exclusion allowed for rental properties, so you'll pay taxes on the profit you make when you sell. But you can do a 1031 exchange, and on that you would reinvest all of the net proceeds from the sale into a replacement property. When you eventually sell the replacement property without doing another 1031 exchange, you'll owe taxes. And there are various rules, so you'll want to work with professionals who are familiar with 1031 exchanges. Even though the exclusions don't apply to rental properties, there are tax advantages to being a landlord. I've been one, and there are deductions available, like depreciation, repairs, upkeep to the property, maintenance. And with a rental, you deduct those expenses yearly from the rent you receive for the year. So that's a pretty good benefit. And clearly in this country, there are some real advantages to owning property. You're building wealth with growing equity, and you've also got tax advantages. Okay, I hope this video was helpful. The video on the right has an overview of what to expect in the 2024 housing market, so check that out. And if you have questions, I'm here. I'd love to help. Okay, thanks again for tuning in. I'll see you next time. Bye.